I'm sure everywhere else. So
That's
whenever you're
great.
ready, Samantha.
Hi, everyone. I'm delighted you could join us today. My name is Samantha Taylor, and I'm an analyst here at iFi Global. Welcome to our podcast and webinar on LP structuring preferences. We are also announcing the launch of our advice service for GPs who are looking to expand in third countries today. We are doing the advice service with ANC Advisors, and we have Dan Strackman, their CEO, joining us today, as well as Simon Osborne, the CEO of iFi Global. Simon is going to give a brief presentation on the first set of results of research we are now doing on a regular basis with LPs on their structuring preferences, as well as outlining why we are launching our advice service for GPs and covering what it includes. We are then going to get into a panel discussion with Dan, and we very much hope to make this as interactive as possible. We would therefore welcome any of your questions. If you would like to ask one, please do use the Q&A button at the bottom of your screen. We should finish at around 10 to the hour, and I will now hand you over to Simon.
Thank you very much, Samantha, and welcome everyone. As usual, when we do these things, we have a lot of people joining us from all over the world. In this particular case, predominantly Europe and the US. And I'm very pleased to see that we have a good number of GPs joining us from the US, so which is exactly who we hope to have with us today amongst the lawyers and others who are with our service providers too. My name is Simon Osborne. I am the CEO of iFi Global, which is a research and media house based in the City of London, although I spend quite a lot of time in the US and partly live in Florida. I'm over in the UK at the moment. We have 3 monthly publications, and we have one weekly, as well as being perhaps slightly larger on our research side than we are on our media side. And as Samantha just mentioned, I'm delighted that we have Dan Strackman with us today. He is the CEO of ANC Advisors. He has a long and distinguished career on Wall Street. He's an author. He works with a lot of managers in the US, and also a keen cigar smoker. I shouldn't forget to say that. The advice service that we are offering GPs is in collaboration with ANC Advisors, and we are very happy to answer any questions people might have on that, and also, of course, on the results of the research study that we will be presenting in a second, and we are now doing on a regular basis since we've started on this venture with Dan. So, Samantha, if you could turn over the first slide. Yeah, why Europe? Let's perhaps just step back for a second and ask this really fundamental question. Why, particularly to those, and luckily there's quite a lot of third country GPs, particularly from the US with us today, why would you want to look to Europe? Basically, 2 broad reasons. The first is that the European economic outlook, and this is the politest word one can probably use for it, is bleak. Some would say it's a lot worse than even bleak, as a result of which investors are diversifying their assets out of this part of the world into others, which is particularly, of course, the US. Just to give you an indication of how bleak it is, some of you may know or may not know that a very big official report was published, I think, in the winter, late last year, by Mario Draghi, who was the used to be the ECB president, is a bigwig in the European Union, very official. He made an extraordinarily bleak report on where Europe is going economically, short, medium, and even long term. And so don't believe me, believe the EU when they say themselves that it's not looking so great over here. But it is an asset-rich environment, a very asset-rich environment. And so investors are looking very much to diversify. Secondly, and this is almost equally as important, Europe is really very accessible to third country GPs. There is the fortress mentality EU concept with all the rules and regulations, and we probably won't really get into that today, but we'll can come back and talk about that in the future. But there are ways around it to a certain extent, and as well as the fact that LPs, generally speaking, are very accessible in this part of the world. There is a lot of very reliable data on them as well. So next slide, please, Samantha. In particular, we see at iFi Global these three following opportunities for US managers or US GPs, whatever term you like to use. The first, and by the way, we've been working this year with an entity which is London-based with an office in San Francisco, which is a sort of private placement agency, cap intro type service that uses AI. And we talked to them a lot about where they see the opportunities for their clients. And they see, particularly in this part of the world, but everywhere, in the family office and high net worth investment space, they see a particular growth into private markets. Growth in private markets is happening everywhere. I'm going to perhaps come on to that in a few minutes when I mention the research results. But at one particular area I do want to touch upon, whether it's in private markets or outside private markets, is sustainable investment. That really is growing very strongly at the moment. And we have a publication called Sustainable Investment Intelligence, which tracks allocations from pension funds, from sovereign wealth funds, from family offices. Investment into a lot of sustainable areas is at record levels and is continuing to grow. And I don't see any reason why it's likely to slow down. Perhaps this is the big growth area, if not of the entire global asset management industry, certainly of the alternative side of it. Next slide, please, Samantha. So bearing all that in mind that I've just mentioned, we are launching what we're calling AIS, which is the name of one of our publications, advice service for GPs. It principally covers these areas which are put up on the screen: LP structuring, preferences, and I'm going to talk about the research in just in a second, European distribution options, of which there are several. And I think it's important to touch upon the geopolitical and macro environment over here. And I think whether you like it or not, geopolitics and markets are getting enmeshed. We're talking today on the day that, we've got this decision from the US on the potential suspension of the tariffs. It's all becoming, what goes on in markets is becoming a lot more political than it ever was. And we can provide, and we do through our macro weekly information on what's going on the European side, indeed on the US side and the Asia Pacific side as well. But it is important to bear in mind that is happening in the background in that area. We have done over the years a lot of work on research of service providers, Mancos, AFIMs, which are a big thing over in this part of the world, and indeed on domiciles and on independent directors. We've done a lot of research going back, if not years and decades, rather than just years. And these are things we like to think we know very well indeed. Indeed, we would believe, and I don't think anyone could refute this, we're perhaps the only entity in the industry, anywhere in the industry, that does research and analysis on these areas of the market on a regular basis. And on top of which, we are entirely independent. We're not trying to sell a jurisdiction, a service provider, or a set of service providers, or Mancos, or directors, or whatever it may be. We have no skin in the game. We would just claim to have a good degree of knowledge and be entirely independent. So that's the end of my introduction. I'm going to quickly go through the headline results of the research. If you can switch to the next slides, please, Samantha. Given the lack of, we haven't got a lot of time, I want to get into the discussion with Dan and with any questions you guys out there might have. So I'm just going to go through the headline results on this, the first set of structuring research we've done with LPs. We're going to continue to do that on a regular basis, hope at least twice a year, conceivably even more often, maybe make it a kind of rolling study. And what we want to do is track the changes as time goes by and see how things are altering. So this set of research will become more valuable in the next 2 or 3 iterations of it, as we can put lovely graphs up showing what's going up and down. But today is the sort of baseline benchmark to begin with. And if you want the sample and more details, that will all be in the June issue of AIS, which is only a few weeks away. So to the first question, do you invest directly in private markets as well as allocate to them via third-party managers? The LPs we surveyed said that, quite interesting, 64% do both. Some, the 32%, i.e. a third, just go third party, and a very small proportion just go direct. Do you plan to increase your direct exposure to private markets? Nearly a quarter of the sample said that they are planning to increase their direct exposure to private markets. And what are the main reasons you go directly and/or use third-party funds when allocating to private markets? It's really very simple. We almost probably didn't even need to ask this question. We probably knew it before, but we did anyway. It's clearly the lack of knowledge a typical LP, a typical pension fund, whoever that may be, that has in a particular area is why they would obviously go and use that particular specialist manager's skills in that particular area. And it's happened on a few occasions. Some people said also the way they go is because it's been mandated by a committee, by their, or as we put here, by an investment policy, maybe to do with the pension fund as to the way they structure things. It may be a sort of down the line, not regulatory, but bureaucratic reason for why they do it that way. Do you use a variety of investment structures when allocating to private markets? This was surprisingly high, at least to me, with a yes of 86%. The next slide, please, Samantha. And what structures, we asked them what structures that they use. The traditional pool pension fund, just over half use that to a greater or lesser extent. Partnerships, the vast majority are using partnerships in whichever area, probably private equity and probably others as well. Maybe real estate, who knows. Managed accounts, nearly a third are using, which is quite high, surprisingly high, perhaps, are using managed accounts. Funds of one, that got some mentions as well. And quite a high number of co-investments, not far short of the number of managed accounts, which I thought was interesting. Next slide, please, Samantha. Do you have preferred investment structures for particular strategies? A third said that they do. Just about, a quarter, just under a quarter said that they do. And then the next question, are there strategies that you are more likely to invest in directly? Pretty much, I put in brackets here real estate, because the answer was 55% said yes. But in that case, it was pretty much all those who are investing directly in real estate rather than going through the third-party manager. That's by far the most common way that these LPs are investing directly. And by the way, such a huge proportion of the people we surveyed are big investors in real estate in whichever form that they are doing it. Is allocating to private markets via tokenization something that you are considering? I thought this might be a little bit higher than it is, but 9% did say that they are at least looking at it. They're not considering, probably a better word than looking at it. Doesn't mean to say they definitely will, or one doesn't know exactly when they will, but it's getting a little bit onto people's radar screens. And that, perhaps if we'd asked this question a year or two ago, it wouldn't have even been anything like 9%. And if when we ask it again, as we will, that figure I would bet quite a lot of money would be jumping up, particularly, by the way,
Hold on,
when you're in
Simon.
the
Hold
family
on.
offices.
Full stop. Sorry to interrupt. I will take that action from you because this number will go down. I will
Oh,
bet. I
okay,
will
a
bet you
debate.
that this number goes down.
Okay.
Sorry, I didn't mean to interrupt you, but that's a deal I'm willing to make. We can't put a box of cigars because you don't smoke, but I would put this number is either going to stay the same or drop.
Oh,
And we can
okay.
talk
Well,
about
fair enough.
that. Just
Well,
giving
we
you
will at least debate that when you over a cigar, when you, at least
when you
one
let
that
me
you'll
when
be
you let me
smoking.
speak today. Oh,
Yeah, I will when I finish, which I almost have. So, if you could switch over to the next slide. So, in conclusion, what this research shows is that um, the in these four areas, I think this is the four takeaways that at least we have from what we've done. Private markets will see a growth in LP allocations. I think probably a significant growth in LP allocations, as many believe public markets are largely indexed with little opportunity for alpha. Um, and secondly, the lack of knowledge or experience in private markets is the main reason why LPs go into third-party managers. And there will be, we believe, a growth, probably potentially a strong growth in investment structuring, diversification. I think the days when it was completely dominated by the traditional partnership structure and the traditional pool fund, they're in decline. And we're going to see probably over the coming years a greater proliferation of structures, which we hope to track. And here, this is a perfect place to bring you in, Dan, because you're going to disagree with this last point strongly. And this is a good point, a good chance for you to say why that we believe this shows why we are two different entities, that tokenization may well potentially upend investment structuring in private markets over the next 3 to 5 years. So that concludes my presentation. Let's bring Dan in. And first of all, please comment on anything you want to comment on. And then we'll talk
Samantha,
about.
I'm sorry, I was jumping in, Simon. I'm excited, raring to go here. Samantha, can you pull back the slides for a minute? I just want to go over some data points because I think, Simon, you touched on the high notes, but I want to just dive into a couple things real quick, if it's possible. Sorry, Samantha, I should have told you that
Yep.
to the briefing or the head up. Can you go to the LP? Well, keep. Okay, let's start. Okay, go back one more. Okay, go back one more. Okay, so I think what's interesting here is the exposure to private markets. If you look at this, 23% of the people said they are going to increase their allocation, but what does that really tell us? That 67%, did I do that math? 77%, sorry, are going to decrease that. And I think that's kind of very interesting to think about. And that's
Sorry, I'm
something.
going to interrupt you now. They're not saying they're going to decrease. They're just not reporting they're going to increase. They may
Right,
be keeping it where it
but if
is.
they're not going to increase, one would say they're either staying the same or decrease. No,
Yeah.
right. So that's kind of an interesting point. If you go to the next slide forward, please. Right. This is fascinating to look at, right? Because I think that what they're saying is that if you look at partnership, if you think about partnerships and co-investments, it means that people are getting more involved, right? I think that's what they're basically saying here, which is kind of a fascinating thing to think about. They're not setting it and forgetting it as they have been for the last 50 years or since 1948 when hedge funds were invented or alternatives were invented. Okay, next slide, please. We killed the tokenization thing. So I know, Simon, I love, Simon, your enthusiasm for tokenization, but I really don't think it's something that we're going to see a whole lot of in this area. And then the next slide, I think, really tells you the story and why what we're doing is so important to GPs. And it's this line right here: the private markets will see a growth, right? Because they believe largely indexed, public markets are largely indexed. And I think what index-based products, and I think what that's telling you and telling all of us is that people want active, engaged managers. And they know that if they want to buy the S&P or the FTSE or any of, the Hang Seng, any of these indexes, they can buy them very, very cheap. But they're scared. They're scared of the volatility, the geopolitical situation that Simon alluded to, and that he and I speak about for hours on end and enjoy our banter about, is something that's made a lot of people nervous, made a lot of people scared, and they're looking for alternatives. And what is the better alternative than the private market, than finding opportunities in actively managed products that are things that they can rely on regarding regardless of when markets are going haywire. I mean, if you looked at what happened just last night, I think the judge or the court, it was a court of they came out, the court ruled that President Trump's may have acted inappropriately in issuing the tariffs, perhaps that he overstepped his bound in the executive. It obviously will be appealed, but the article, the first line of the article was tariffs overturned or ruled inappropriate, markets to rally was the second sentence, right? And if you looked at across every newspaper or news service, because I guess people don't really read newspapers anymore, although I do. If you looked at the FT, the Wall Street Journal, that was all they were saying last night. CNBC published the same thing. It was, and here we are today, 9:22 a.m. in New York, and what's happening? Markets are up $1, a minimum of $1. I think the S&P was up almost 2 when I last looked at futures. I think in general, this volatility and what we're experiencing just today is the reason for the first point on this slide, and I think that's fascinating. I think it shows why this is a great opportunity for GPs to look for new assets and grow their business, and why IFI and ANC have gotten together to come form this partnership and really work together to help people understand the markets. So sorry, Sam.
Thanks for that. What I wanted to start off by asking you is, from your vantage point, being based over there on the other side of the pond, and you work with managers in various guises. What do you see in terms of US managers coming to Europe? What trends do you see?
Yeah, we work with managers all over the world, right? We touch about 56 billion in assets through our ANC platform, and I would tell you that most of the managers that we talk to, whether they're in the US, whether they're outside of the US, are looking to Europe for things that you mentioned and that we found out, right, in our research. We are seeing managers looking for ways to raise assets. Everybody's always interested in increasing assets under management. We're also seeing a significant uptick in the idea that there are asset pools or markets for assets that have been untouched by many U.S. managers, and we're seeing that with a lot of managers who are looking to come to Europe to build products. And one of the reasons they like Europe in particular is because the structures are portable, right? You can go throughout Europe with one entity. It's the number one thing when we talk to managers is make sure you think about objections that a potential investor is going to have when they open the book. And sure enough, if you can build a product in one of the domiciles in Europe or the islands, you can really get yourself a product that will not the objections are not going to be, well, you're not in the right domicile or you don't have the right Manco or something like that. So I think that's a big reason to go to Europe. And it's easier to raise money from Europe to European products than it is if you're in the US bringing a Cayman, a BVI, or a Delaware sort of product. The other thing is, and you touched on this, I think that, and this is something that people are very critical of me and my comments about this particular pool of assets, is that there's if you talk to anybody in the alternative space for the last 5-10 years, everyone's talking about grabbing assets from family offices and high net worth people. And clearly there are some real family offices in the US, but most of the family offices that you run into are sketchy at best. I mean, obviously Bill Gates and Michael Dell and the Pritzker family and obviously I'm trying to think the Trump organization. I mean, those were real family offices. The Clinton organization, the Obamas, those are real family offices, in the Zuckerbergs, etc. But there are a lot of people who just, fly around and flit around telling us that they're family offices, where the exact opposite in Europe, right? You have families that have been there for hundreds of years in all sorts of industries, whether it's manufacturing, whether it's automobiles, whether it's pharmaceuticals, whether it's retail. I mean, and these are families that are you can literally reach out and touch in various stores and locations throughout the world, and that's real assets, and there's real money there. And I think people have come to the conclusion that that's a great place to go and hunt for assets and grow their assets. So that's why this whole trend of going to Europe is really evolved, and it continues to grow and is something that will continue for some time.
Yeah. And before I'm going to ask Samantha in a second, because I see there have been some questions coming in to maybe read out one or two of those. But before we do that, have you noticed over, say, whatever, the last 3-5 years, a particular growth in terms of interest in Europe from the US? Or has it been about the same level as it's always been?
No, I think that we're seeing a real uptick in the number of people who are looking to go to Europe. I think that, number one, as we all know, we've been in the markets forever and a day. We know that the issue with with managers is they just want to know how to play the game, right? They want to know what the rules are and they want to act appropriately so they don't run afoul of the regulators. And I think now that that's very clear, very, very set out, it's much easier for people to think about going to Europe. I think that there's what we're seeing is managers saying it's a great opportunity to go into to Europe and build these types of products and get people excited about them, specifically if you're bringing a European product to European investors.
And just one more question, then we'll go to what I see more questions coming in, which is great. And so let's go to those in a second. But one last question to you, Dan, on the types. Are you seeing any difference in the types of managers? Because we see one thing that's really interesting since COVID for us, since we started doing online events, is the amount of managers in the US is just dramatically bigger than we have over on this side of the pond. There aren't that many entrepreneurial boutique managers sitting around in Europe, but they're all over the US in huge numbers. Do you see any trends in that in terms of where who's coming to Europe in which categories, whether it be by size or by investment strategy or by anything else?
So I would say that the big players in the U.S. have already gotten to Europe, right? I mean, you're talking
long time ago, yeah,
right. They've been there and they're established and they're building their business. I would say you're looking at managers between 2 billion to 150 million AUM in dollars.
Even that small size, the 150 million managers.
Yeah, we're working with a manager right now that has just about 175, and they're looking for it. And the reason for that is because a real family office in Italy, right, came to them and said, we want a product, but we want the product in Europe. And so they said, well, if the money's there, we're going to build it, right? They're coming, so they're building it, right? Versus if you build it, they will come. And I think that's what people are saying. You know that reference, you guys? That's from the great movie. I mean, come on now. Funny today. Samantha's on my side, Simon, just saying. Yeah. Anyway, but no, I think to your point, and I think that what we're seeing is more niche strategies to really answer your question. We're seeing more niche strategies, whether it's long only small cap Japanese market. We see a product like that, managed futures, some real estate, particularly self-storage. I don't know if that's a big thing in Europe as it is here. It's massive in the United States. And that's a big issue that people are, big strategy people are looking at. So that'd be a unique real estate strategy, if you will. But the traditional strategies as well, but not as interesting. Long, short equity, fixed income arb, that stuff's been there, done that kind of thing. It's really people with niche strategies coming over.
Right. So let's go to questions. Samantha, you want to read out what we've got? That's the first one or two.
Okay. So someone said that she agrees with Daniel regarding tokenization after listening to interesting webinar on
I bet he planted
that.
Strachman won. Go ahead.
Yeah, a webinar on USD, RMB, and digital currencies yesterday. Stablecoins may increase, but she doesn't see digital currencies and tokenization taking off really.
Right. Okay, and then
Is there a
can
question
you read
in
out the
that?
next? That's a,
Other than that was my wife who sent that in to say how great I am.
Right,
um,
so the first question we have is, do most LPs care whether we use one entity for administration, Manco, and other service provider work, or should we be looking at using different organizations for all of this?
I think we both should have an answer. Try to answer that. Do you want to go first, Dan?
So the short answer is yes. You know, the idea of one-stop shopping is one that is some people find problematic. And in light of the infestation of private equity into firms that offer administration, that offer directorships, that offer compliance, there's a bit of concern, similar to the concern that people have with some of the law firms that offer independent directorships and that administration, that if you put all your eggs in one basket, you run the risk of, number one, not having good governance, number two, not having great service from your administration, and number three, running afoul of regulation or compliance issues. So it is important, we think, to diversify, and also it's better, you know, in my opinion, of course, but it's better to have firms that specialize in specific things than it is to use, you know, sort of the Walmart approach, as we see with many of these, um, you know, administration companies that are calling themselves diversified financial companies that have been, you know, taken out by PE at multiples that are unsustainable, and they're just dying for business.
Yeah, I'll just say the unfortunately or fortunately, depending on your point of view, there is a strong trend to using what Dan has just called the Walmart approach because it's cheaper. And if managers feel, quote unquote, they can get away with it if that's the right, and that's what that depends on the investors.
Right.
And if the investors care, then they will probably diversify their service provider offering. But if they don't care, they're going to go for the simplest, cheapest, quickest solution. And that's just the way of the world. And I'm afraid our research, and we're completely unbiased on this, just from picking up on what we do in the market, that's what it's showing. It is going to the one-stop shop answer solution in a way that it hasn't done perhaps before in the same degree.
Right.
Do you want to do the next one, Samantha?
Yeah, so the next question is, we have had conflicting advice on using reverse solicitation in Europe. Is it being cracked down on now?
Do you want to have a go at that one, Dan? Do you know about reverse solicitation?
Yeah, so look, I don't know what they mean by crackdown, but I think the regulation is very clear on reverse solicitation. We understand what the rules are. And if you're playing in the market, you need to play by the rules. And it's very important to pay attention to the rules, because the worst thing in the world is to run afoul of the regulation and have to deal with the regulators because you made a mistake about something that you knew was the wrong thing to do, right? And we all know what those rules are. We know what the regulations are and how they're to be implemented and used. And so I think the answer is, I don't know if they're cracking down. I'm not sure what cracking down means, but I would say that you know what the rules are. Whoever asked this question, I can't see who asked the question, so you know what the rules are, and I would suggest you abide by them, and be able to sleep at night rather than
Yeah.
not
Well,
be
this
able
is the joy of doing this thing with you, Dan, because we have, again, different set of opinions. I don't know whether this person means by cracking down what I'm about to say, but when the European Cross-Border Distribution Directive came in, there was a lot of talk about reverse solicitation coming to an end, and a lot of people did get worried about it. In fact, we ran a very well-attended webcast at the time, going back 2 years, if not more, ago. And there was a bit of a concern that it was going. I have asked this question many times to many people over many years. I have not got any examples of anyone who's fallen afoul of the law because of using reverse solicitation, but particularly they need to have a darn good law firm. And if they're American, they generally speaking do have darn good law firms. Probably one of the ones, there's a few of them on this call today, or their partners in London or Dublin or Luxembourg or wherever they are. You really do need to get your legal sorted out if you're going to go down the reverse solicitation route. But one hears all these scare stories about what could go wrong. And if you lose money in a fund and you've been in a reverse solicitation situation, in theory, the manager has to pay you back. But I've never heard of that actually happening in reality. So whoever asked that question, I don't want to get sued for saying this, but I'd say as long as you have a darn good law firm, you should be all right. But don't abuse it. Don't go crazy. And don't use it as a distribution strategy. It's a way of putting your foot into the water and seeing what's going on.
Okay, so just to be 100% clear, I completely disagree with Simon, and I stand by my comment that you need to abide by the regulations regardless of how good or bad your law firm is. Okay, I'm not going in that water. I'm not putting my toe in that water with you, Simon, at all.
Fair enough. Fair enough. So next month, what's the next one then, Samantha?
Yeah, so someone's asked, what are the main sustainable sectors that European LPs are interested in at the moment?
Of all the people on this panel, who's probably best answering that question, that would probably be you, Samantha, because she puts together for us on a continuous stroke regular basis for our sustainable investment intelligence publication, allocations from pension funds, in family offices and sovereign wealth funds, and we've got a huge amount of data now. So you know these figures better than me. You should answer this. Renewables, they're virtually all going into renewables, aren't they?
Yeah, renewables is, I think, by and large, the most popular category that we track. So we track renewable energy, sustainable water usage and treatment, biodiversity, nature and agriculture, timber and forestry, and waste management and the circular economy. So pension funds across the board, the popular category is renewable energy. Sovereign wealth funds the same. Family offices, yes, and regenerative agriculture is following, as well as aquaculture.
And biodiversity stroke nature is the one that I think you found was the fastest growing. I mean, they're all virtually already in renewables, but after that, the one that's growing quickly, is it biodiversity stroke nature?
Yeah, it's the whole natural capital area, and within that, there are movers into regenerative agriculture and biodiversity.
Yeah. And that's probably, Dan, correct me if I'm wrong, I would say that's the one big growth area in the business right now, the whole sustainable sector.
Yeah, I don't think they're calling it sustainable. I think they're calling it alternatives, right? I think that's right. Sustainable is a word that has sort of fallen out of favor a little bit, but just in the description. But I think you're right. The other area that people are very focused on in the U.S., particular to this, is obviously nuclear power, because they're looking for alternative energy sources, and there's big issues there right now. They're big opportunities. But yeah, you're right, Simon. People are looking at these things in a very big way, but and it's stuff we need, right? Food, water, garbage. We need to figure out solutions for them. Absolutely.
I see the next question. Somebody has answered. I'm going to exert executive authority and not go back onto reverse law. We'll put some of this in, publish this in the June issue of AIS, but somebody's come back with some more points about reverse solicitation. So can we go to the one after that?
Yeah, so the next person is asked, we've seen a wide variety of fees quoted for service provider / AFIM work in Ireland and Luxembourg. How negotiable are fees?
Dan probably knows the answer to that better than me. I've got some answers too, but you've probably done some negotiating on that.
Yeah, I mean, look, I think all fees are negotiable at this point. I think that there's, right now, and Simon, your data might be different than ours, but right now, fund launches are down across the board. New product launches are down across the board, and not that lawyers are hungry and service providers are starving, but service providers across the board are hungrier than they've been in a few years, and I think that gives it a great opportunity for people to negotiate fees. But the one thing you need to think about is sometimes you really do get what you pay for. And while the cheapest solution sometimes appears to be the best, it most often is not the best. You need to really look at the quality of the people you're going to be working with, the quality of the people that are going to be doing your work on an ongoing basis, and really make a determination based on that. Fees, while important, and we all agree that fees are, something that we all pay attention to, They shouldn't be the most important thing. The most important thing is number one is the relationship you're building with the service providers and their ability to get your work done, in a timely and efficient, correct manner.
Yeah, all I would add to that is we have seen, I think it's much less today than it used to be, but in the days, particularly in the boom, when these service providers were going through an incredible degree of M&A, depending on where they came from, they would, discount fees in a certain area to get business in another area, whatever it was. I think those days are probably, if not over, they're substantially, we're in a different place today than we were, say, 3 or 4 or 5 years ago on that. But there is, and in Mancos, there are still some that do have a certain set fee, and others that do a bit of set and variable based on basis points of the underlying assets.
So Simon, one point, I think that's what you just said is really spot on. One thing that when it comes to fees, it's very important to make sure you understand all of the fees that you're going to be charged through the engagement. Make sure it's crystal clear. Whether it's what the law firms are charging, what the Manco's charging, whatever. Make sure it's crystal clear and you understand what it is, and also make sure that they lay out what services you're paying for, so that if you do, run afoul of or needing additional services, what those are going to be as well, because it's important. A lot of times, not that there's bait and switches going on, but there's a bit of bait and switch going on right now too. We see that quite a bit.
Right. We haven't got a lot of time left. I'm just going through looking at the questions with you, Samantha. Should we go to, there's one at the bottom there I see on domiciliation. Should we go to that one? I see there's other people. Sorry, go on.
In terms of jurisdictions for US sponsors, is it really just Luxembourg or Ireland? And is one better for US sponsors?
Do you want to go with that, Dan?
Well, I think that I'm not sure one is better than the other. I think that they're very similar. I think that they both offer great opportunities for people to bring products to Europe. I think that it comes down to where you think where your investors like, what your investors like better. But in reality, I think it doesn't matter. With apologies, sorry, Simon. With apologies to the Irish lawyers and the Luxembourg lawyers on the call, I'm sure you guys are carrying your flags much higher than I am. I don't think it matters.
I wasn't going to say anything about Dublin and Luxembourg. I think they've now become, they weren't always, but I'd say from what we see anyway, they're very similar in terms of the offerings in both jurisdictions, and the fees are very similar in both jurisdictions now. There used to be a time when perhaps it was a little bit cheaper in Ireland than it was in Luxembourg. That's, I don't think, the case anymore. But there are other jurisdictions. There's Guernsey and Jersey, if you want to have an offshore jurisdiction in the European region. And if you're not going to be, if you're depending on who you're trying to reach with your fund, if you're not trying to market it across all the European markets, then there's no reason why you necessarily have to be onshore in the EU. So bear that in mind. Indeed, you can probably, everyone will have a Cayman fund, and you can, or BVI, whatever it is, and you can probably get away with doing that if you are looking at the family office market or looking at certain jurisdictions where you're going to be going for private placements. And if you're going for private placements, say in Northern Europe, you're probably fine with going, well, say one of the Channel Islands, which has, is keeping up with private placement. It's more difficult in some of the Southern European markets. Germany, it's always been difficult and it's getting no easier. So it depends on, every situation is different, every fund is different. So the service Dan and I are looking to do takes that into account, that no two funds are identical. Everyone has slightly different priorities, slightly different investor categories thereafter. So you can't say it's right for, this solution is right for everybody. Everyone's going to probably want something slightly different. It has to be bespoke. It can't just be off the peg.
Well said. Well said.
And have we got any? We've got about 5 minutes left before we said we'd wrap up. Have we got any other questions we haven't done with, or we could even go to several of the comments that have come in too?
Well, just quickly, someone's said, many see the need to have a structure in either Ireland or Luxembourg. Both have real capacity constraints. Any thoughts for US entities trying to enter?
Yeah, well, what do you think about capacity constraints? Have you any thoughts on that, Dan?
I really don't. I just think in general, you need to think about where your investors are coming from and what they want and give them that product. And you'll have to, capacity constraints are an interesting issue. I think, a lot of people say they're going to launch with $1 billion and they end up launching with, 500 million. So I think you have to just really think about what your investors are going to deliver in and how you're going to get there.
I don't know whether when they say capacity constraints, are they talking about personnel issues?
Oh, I didn't even think of that. Yeah, sorry.
Um, are they? Well, probably. I don't know. Whoever asked that question. But yeah, one's heard this for a long, long, long time in both Ireland and Luxembourg. I can't believe how much they've changed in all the many years I've been going to them. They're enormous centers of the fund service providing side of the fund industry. They've changed. Both places have changed out of all recognition over the last few years. But fitting those people in those offices, I don't know what the employment. There used to be quite a lot of, not so much in Luxembourg, but in Ireland, there was quite a lot of people moving around for 2 or 3 thousand euros more a year salary. People were jumping around from place to place, and it was difficult to get housing in the greater Dublin area. I don't know whether that's still the case. No one's really brought that up to me anyway in the last year or two. But yeah, it's boomed like Billio over the last decade. Right, are we coming to the end? I guess we are. I don't think is there any other particularly key question we could quickly do a fast answer to or not?
Uh, no, I don't think so. Someone's obviously commented about reverse solicitation, but other than that, we have no other questions.
Simon, we should do a whole panel on reverse solicitation. It seems like it's the hot
Well, we
topic.
should definitely do a whole panel on distribution. And
Yeah.
the joy is we disagree, so that would make it very entertaining. Should we say our goodbyes and say hopefully see you the next time?
I think
It's
so.
probably the time to do that. All right. Well, I'll just say thank you very much, those of you who are still with us, for joining us today. We hope you find it useful. To repeat what I said at the beginning, this is the launch of this advisory service. If you're a GP following this right now, we'd love to talk to you, and you can basically get advice from us as a subscriber for free. If you want to go to the next level and get something more detailed, then we'll negotiate something with you. But if you want to get the basic information on the distribution, the service provider selection, the domicile selection, the director selection, or whatever it is, we will happily provide that to our subscribers without charge.
Right. And Simon, the one thing I want to add, which is we talked about before, was this webinar and the data will be available on our website, on Simon's website, and they're really cool YouTube channel. So please feel free to watch it many, many times over and over again, because there's so much information that we have here for you, but also share with everybody who wants to really learn and get unbiased views on what's happening.
Fantastic. Well, thank you, everybody, and hopefully see you the next time. Bye-bye.
Bye-bye.